We're going to get started with our sports investing panel. First, I'd like to welcome one of our stalwarts, I think on since the beginning, a dear friend, Sal Galatioto, who is the founder of Galatioto Sports Partners, the preeminent sports advisory firm that he founded out in 2005 after building similar groups at Lehman Brothers and SocGen. New this year, we have Arun Manikundalam, who is a team member at Dynasty Equity. Before that, he was at Silver Lake, investing across media and sports. And for those of you who don't know, Dynasty was one of the 4 firms that was blessed by the NFL about a year ago to make investments of up to 10% in various teams. So that's a good segue to put up the next slide. Just a reminder of the ownership guidelines across the Big 4 leagues plus soccer. And you can't pick up the paper without reading about another team transaction. Just in the last few weeks, we've had the Niners, the Eagles, the Dolphins all trade minority stakes at notional $8 billion plus. And you had the Celtics at $6.5 billion plus. But interestingly, those were led, for the most part, by high net worth individuals, the same group as with leading transactions before. So maybe we'll start with Sal. How is this market? You've been doing this for decades. How has this market evolved? And are the new rules really flushing out new buyers?
No. All I read about in the newspaper is how private equity's changed the world. I've raised $1.75 billion I've sold of private equity stakes, okay, of limited partnership stakes, in the last 22 months. Anybody hazard to guess how much of that I've sold to funds or private equity?
A low number.
Low number? Yes, a low number. Zero. Nada, niente. Actually, zero is technically not a number. It's a placeholder. None. You know why? Because I'm willing to work hard. It's easy to sell it to a fund, okay? But if I dig and I work, the average price between what the bids I've gotten from funds and what I finally got from high net worth individuals is an average of around 26%. So if I work hard, I can place the paper with people who really want that specific team, who are willing to pay a premium, a scarcity premium for that team, and I can place it very efficiently. It takes time, it takes effort, but I'm willing to put that in because I work for my clients.
So you might have a prospective buyer sitting next to you. Arun, why don't you give us your perspective on the institutionalization of capital and some perspective on how you might be approaching this a little differently than others.
Yeah, look, I think we're still in relatively early days, right? Leagues changed their rules not more than a handful of years ago. You're starting to see a lot of institutions get started around this ecosystem. You can call it competing, complementary with high net worth. Clearly, there is still high net worth demand for these assets, and rightfully so. And I think as institutions, we're all approaching it differently, right? We're at Dynasty, we're seeking to be value-added capital to the whole sports ecosystem. That can be IP owners like teams and leagues. That can be assets that sit in the operating kind of adjacencies around sports, the picks and shovels. And so I think we're all trying to navigate this path in what's still relatively a new landscape for institutional capital, especially on the team side.
So Sal, any perspective on, obviously these teams have been run by, in many cases, families that have known each other for a very long period of time. As we get more institutional capital, how do you think, will the way that leagues and teams have been run change, for better or for worse?
Look, right now, I've never seen demand this strong, okay? Right now, I'm a 9-person firm, tiny, right? We punch way above our weight. So right now, we're selling a piece of an NBA team, pretty big piece. We're selling a piece of a National Football League team, which nobody will ever hear about because the existing partners will buy it in. I guess the one public one is we're raising $550 million for the A's move to Las Vegas. I have 2 other baseball transactions that are smaller, one that's $100 million, the other one is $60 million piece. Every single one will be sold to a high net worth individual. because I can get a higher price. If that changes at some point, look, I'm going to get the best deal for my clients. If I'm on the sell side, I'm going to take the last dollar off the table. But I think that's going to be difficult to do because there's scarcity value here, right? There are a fixed number of teams. Yes, we have expansion once every 25 years and they add a team or two, but basically the inventory's fixed. Okay, I don't remember a lot from my economics courses, which I paid a fortune for, but I do remember that if supply is basically fixed and demand continues to grow, what happens to price? It goes up. That's all I remember. And that's all I need to remember. And I can always find multiple people to bid on an LP stake. And as long as I have that, I can create competitive tension and drive price way above what an institutional investor is willing to pay me. And until that changes, I'm going to keep doing the same thing every day.
Now, it's interesting because obviously this is a media conference, so many of us are painfully aware of the changes in the media ecosystem, and media rights, it's often thought, underpin the value for franchises. And are buyers just looking through to whatever the end game is for that media ecosystem as they're bidding? Do they just not care? How are they viewing the change in media rights?
It's a bump. It's a hiccup. Look, there's nothing like this media content. 99.5% of people that watch sports watch it live. As technology continues to improve and people are able to record their favorite shows and edit out the commercials, guess what? The value of sports is going to continue to go up. There's no other content like this. And until somebody invents that content, it's going to dominate. And someone will pay for the content as long as you own it. I don't care how it's distributed, whether it's over the air or on somebody's telephone or over, it doesn't matter. Someone will pay for it. And that's what most buyers look at. And it's been, look, I've been in this business since 1997, and everybody who loses a bid says the guy that won overpaid. They've been wrong for, I don't know, almost 30 years, and I think they're going to be wrong for another 30 years.
You have a take, Arun? Yep.
I would agree with everything you said on the media front. I think, if you look at the trends in content consumption, yes, there is an uptick in shorter form content being watched and generational habits, but as pay TV has declined on the linear side from over 100 million subs to less than 70 million subs, sports viewership live has pretty much held steady. And, you could argue sports is propping up that pay TV ecosystem still today with news every 4 years. And so it is a matter of how it's distributed. Now you see technology companies starting to bid big dollars on rights. That's increased competition in the space. That's overall healthy for the sports ecosystem. So it's a matter of how the content gets into consumers' hands, how it's packaged. And I think we're seeing an increase in demand, if anything else. So we continue to be excited by the media landscape.
I mean, think about this, all right? These brands are incredible. There are a whole bunch of academic studies which you can find that will tell you that if you're 9 years old and you're wearing the hat of your favorite team, you're more likely to change your religion than to change your team affiliation. What other product can you say that about? Automobiles, watches, neighborhoods? No. This is incredibly sticky, and it's almost tribal. People believe that they're the owners of the teams, and so they're going to follow those teams. Even when they move from one place to another, they don't lose their team affiliation, and that's great because they'll consume that content no matter where they are.
That's exactly right. And I just add, when we think about it, sports teams itself, as you said, they're brands, and you can call them fans, you can call them customers too. Those customers have very little acquisition costs because you're born into it in many cases based on your geography. And I think we're at the earlier stages of thinking about the value of those customers, right? Brands have acquired them for basically zero, and now they're sitting on them and figuring out what to do. And at Dynasty, that's opportunity for us to hopefully help team owners, leagues, ecosystem assets navigate that shifting landscape.
And, we don't often hear about technology as a driver for team values. In fact, I've often pitched investments in the Braves and MSG as sort of anti-AI plays because it's hard to replicate that in AI. But how should we think about technology? And I know Arun, you've thought about the opportunity, broader set of opportunities to increase technology in sports.
Yeah, I'm happy to start, and I'd maybe use a case study of ours, which is our investment in Tomorrow Sports. Tomorrow's, at least today, it is the partnership with the PGA Tour and TGL with Tiger and Rory. And we thought, what better way to play this trend of shorter form content consumption focused on star power with an existing brand like the PGA than to do it kind of as an extension of that content. So it's still a content-driven investment. It's very much media-focused, but it's with new technology, with simulator-based, shorter form, live on ESPN in prime time in a pretty interesting part of the sports calendar. And now we're sitting there thinking about, okay, how can we do that, not just with golf, but maybe with other leagues out there. And so that's been really interesting. And so we're seeing how technology is affecting consumer habits, how it's affecting the way teams, monetize their content, and then, seeing how to best invest behind those trends.
As AI and technology continue, people are going to have more and more leisure time, whether they like it or not. And don't even get me started on AI because it scares the crap out of me. But at any rate, okay, people are going to have more leisure time. They're going to need to find things to consume, content to consume. Sports is incredible content. It just is. There's nothing else like it. And that's why it's not a bubble. Look, think about this. What's the worst that could have happened to Major League Sports? The worst thing that could happen. A pandemic, right? You can't play. You can't make any money. Yet, did a single team go bankrupt in those leagues? No, not a single one. They were able, because league rules keep that down. They keep these incredibly stable. They have inherent value because of their brand value. And when the pandemic ended, they bounced back incredibly. I mean, they did. And I don't think anything can stop this trend. Nothing short of,
Another pandemic.
another pandemic or somebody actually pushing the red button, in which case we won't have to worry about sports or any other investment or returns.
You're always so optimistic, Sal. But
Well, it's not that. I'm also a student of history.
Understood.
And man is not the most stable creature on the planet.
Well, that's true. Well, in the meantime, we can all go to some of the real estate developments that surround stadiums. The Braves, who are here with us later, perfected that model with the Battery. It's a great place to spend a day. How important a driver is real estate development behind what teams are doing? And a lot of teams are copying that model, including the Giants and others.
I'm happy to start. I mean, it's a huge driver, right? I think teams that do it are clearly differentiated in certain cases, and it's something that we certainly look at. It's something that potentially we look to invest behind as well. All of those real estate developments, they require capital, and that is, if nothing else, that is one of the roles of private equity is capital. And so a lot of our conversations are focused on, okay, where can we put dollars to work for growth, not just in ownership liquidity, which has its attractions too, and part of that is on the real estate side. And there's been a tremendous amount of innovation in it. I think you've seen certain teams do it extremely well, and now those that haven't yet are looking at it and saying, okay, they clearly have something I don't. Let me see if I can replicate.
I'll shift to a couple of more pointed questions. So one of the attractions of team ownership, particularly for high net worth individuals, has been the ability to amortize the cost of the acquisition against personal income over 15 years. One big, beautiful bill is written and limits that ability, actually cuts it in half. Is that something that we should be concerned about with regard to multiples and the appetite for your franchises?
Let's see. Not counting the transactions I'm working on now, I've completed in my career 137 transactions In 137 transactions, no one has ever asked me about the tax consequences. No one. So unless that changes, and no one is asking me right now in the transactions I'm working on, and we know what the big, beautiful bill says.
Well, is that because that's not necessarily available to minority owners versus in a control transaction, or?
No, I mean, you get step-up provisions if you're buying from someone who's already an owner and you're selling to somebody else. If it's not new issuance, you can get step-up provisions, you can get tax shelter. But people aren't buying these things for tax shelter. They're buying them because they're unique transactions. They have very little correlation to the stock market. Let me tell you a story. Okay, during the Great Recession, okay, 6 weeks before Bear Stearns, I was going to say went bankrupt, but I know someone in this room will tell me Bear Stearns did not go bankrupt. They did. This federal government just saved them and forced J.P. Morgan to buy them. Okay, they got into distress. Let's see what happened. So I get hired by the Cubs, okay, the Ricketts family, to buy the Cubs. All right, so the world banking system's on the verge of collapse. Lehman Brothers collapses. The freaking Tribune companies, which own the Cubs, files for bankruptcy. We had to buy the Cubs through a 363 sale, bankruptcy, out of a bankruptcy court. We wound up paying the highest price ever paid for a Major League Baseball team up to that date, in the middle of the Great Recession. Okay, it was so bad that Sam Zell wanted a leveraged limited partnership structure, so we had to get debt, even though we didn't need debt. And between Citi, Bank of America, and J.P. Morgan, they wouldn't underwrite $300 million in debt against an $845 purchase price to a buyer who had extremely deep pockets. I had to step up with $50 million of my own firm's money to close out the deal. Okay, all right. During the Great Recession, there were 7 control sales. 6 of them sold for record prices. The one that didn't was the Pittsburgh Steelers, because one of the brothers bought in his other brothers at a below market price. In that transaction, I had an all-cash buyer that would have made it the highest price ever paid for an NFL deal. What other asset class can you say that about during the Great Recession? Answer, none.
All right, we're going to build towards the question of whether we're in a bubble for sports franchises, and I think I know the answer already, but a few other things before we get there. One is, and Sal, I know you're a big baseball fan, as am I. The CBA, the baseball CBA expires December 2026. First, what are the chances, what are the odds you think that baseball can trade a salary floor for a salary cap? And would the existence of a cap or the implementation of a cap in baseball make that league more attractive for buyers?
Right now, baseball, if you look at the revenue multiples, is the lowest of the 4 major leagues.
Right.
It is tremendously undervalued. I have never seen the owners, and I personally know 28 of the 30 owners. I've never seen them more united. I think there will be a lockout. I think there will be a salary cap, and I think it will completely change league economics, team economics, and the revenue multiples will go up significantly. So I am very bullish on baseball right now, very bullish.
Interesting. Arun, you have any take on that one?
I mean, I won't speak to the matters of the CBA. I'd be curious what the Braves say later, but I will say, salary caps, cost controls, ultimately profitability, something that we absolutely look at and value. And so, as Sal said, if that does get done, that's obviously net good for the ecosystem, for the health of everything. And I think buyer interest should reflect that.
Let's shift gears a little bit. We've been focused on sort of the big 4 established leagues. You hear about pickleball, you hear about lots of other emerging sports. Arun, tell us what has been catching your interest. What do you think is investable, at least in the private markets today?
Yeah, look, in the private markets, we made our investment in Tomorrow Sports, and in the emerging part of the landscape, that kind of thread the needle nicely between new league, new form of content, but really an extension of something that already existed, which was the PGA Tour and their stars. we do think about the world as in sports on the IP owner side as media driven, and that is a media driven company. There's a lot of other things out there, as you mentioned, pickleball and others that don't necessarily have the media angle, at least today. And I think we see them get, funding and capitalized by a different set of buyers and investors. And so I think all of that, increased capital demand in the ecosystem, early stage leagues getting more and more funding. That's good for the ecosystem. That's good for innovation. Not necessarily something that fits within us today, but we monitor all of that stuff.
So I know it's not golf for you, but other than that, anything that buyers are asking about?
Baseball, football, basketball, hockey, maybe European soccer. We do a few deals in Europe, as painful as that is. I stick to my knitting. I can talk about those sports, emerging sports. There's huge upside and huge downside. I don't know. I don't know what's going to succeed and what's not going to succeed. So, my opinion wouldn't be worth very much.
Okay. We'll pause there for a moment and go to the audience for any questions. Let's go to Mario first.
Oh, thank you. Just flesh out what welcome. Soccer. Next year we have the World Cup. It's at Met Stadium. It's in Mexico City. The companies are trading publicly. Abu Dhabi owns Man City. Somebody else owns the one in Paris that just won, whose name I can't remember, the Paris blah, blah.
PSG.
Yeah, Paris.
Thank you. And how important is non-U.S. buyers to America? Are they permitted under the rules to own GPLP interests? And what kind of success are you getting there? The second part is fairly simple. 1919, White Sox. How important is the passport, the gambling rules, to the revenue streams of the leagues and in terms of advertising values and to the owners? Anything unusual about that?
I mean, gaming is a huge tailwind for sports because what it actually does is it doesn't directly impact the teams. In some small way it does through advertising and other things, but what it actually does is it impacts the number of fans consuming the games. Because if I'm a Yankee fan, I could care less if the San Francisco Giants are playing the Colorado Rockies. But if I had money on the game, I'd be consuming it. I'd be watching it, right? So gambling is a big tailwind. And if you look at what happened in European sports, when gambling was legalized in the EPL, for instance, viewership went way up. So I think that's a good thing. I think the other question that you asked about foreign buyers being able to come in to the U.S. market, right now we're raising money for, I mentioned the Oakland A's, not Oakland A's anymore, I should stop saying that, Las Vegas A's. We have a fair amount of money coming in from the Far East into that project. I think we see Middle Eastern money starting to look at NBA. The leagues allow it. They won't allow sovereign wealth funds to do it yet, although that's changing, Mario. That evolves. Look, as I always say, it's not about the money, it's about the money. So when valuations get high enough and they need new buyers and new investors, they will change the rules. It's not like, we have to pass a constitutional amendment here to change the rules. It's a bunch of guys sitting around the table at a league meeting that can change the rules at any time, and they will, to their advantage.
Maybe I'll hop in. Hi,
Yeah,
everybody, I'm Jason. Thank you for accommodating me, teleporting from another panel.
So hold on, let me give you the proper introduction
Yes,
because you were my surprise guest. So Jason Wright is a star. Not only has he played in the NFL for 7 years, he was a partner at McKinsey. He was president of the Commanders and facilitated the sale of that franchise, and is now leading something called Project Level, which we'll get to in a moment. But why don't
Yeah, I
you
just want to
comment
build on
that?
what you're saying. I think you're spot on. A couple things. One, I think you will see the smaller, scrappier leagues start to bring in sovereign investment more directly first because the need is there. And then the slower movers, like the NFL doesn't have to until it has to. And so they'll be a later mover, but you'll see it sort of come up the funnel in terms of maturity and size and scale of the leagues. And I think what you'll see in the bigger leagues to start, that will be a portend of direct investment coming from foreign entities, are partnership deals at scale with companies and brands that we know foreign governments are behind and supporting. And once you see those partnerships at scale, getting things like naming rights deals done at the team level or marquee partnerships at the league level, that is going to pretend, that's the way you test the waters on this. And without speaking outside of school, like those discussions have been happening in the backgrounds. You'll start to see partnerships like that emerge on the sponsorship side, and that'll be the first indicator. Now, as it goes to Europe, we're Women's Sports Investing Fund, and so we are looking at Europe as well. I think Europe is an interesting place for the economic model in sports. The fandom there is more fierce and ferocious. There's more history behind the biggest brands there than there are, simply because of the age of the country vis-a-vis the NFL. NFL is like our best thing that we have, and it doesn't compare to the history of the big European brands, especially in the English Premier League. That said, the commercial levers you can pull to run EBITDA profitable franchises there are not the same that we can pull here. And so no one has quite nailed the playbook to run a profit and cash generating enterprise there at scale in the way that has happened across U.S. sports. For example, if you try to raise pricing the way that I did at the Commanders several times before we were winning, you will get stabbed by the fan base. Because as much as NFL teams are a community trust, it's even more so prevalent in Europe, that sense of connection to community and a fiduciary, almost civic responsibility of an ownership group to care for the fan base as a family. And so it's one of the things that we're trying to figure out between market demographics and ownership groups. Where do we find the investment opportunity, at least at the team level? Leagues are different, supporting infrastructure different, but where at the team level in Europe can we find something that's going to bring the IRR and expected return in terms of cash over the life cycle of a team that we would find here in the U.S., and especially in women's sports, which is more like the small cap of sports and nascent and growing.
Arun, did you want to add anything on that?
I don't know if I have anything to add.
Okay.
That was well covered.
So, Jason, we were just talking about some emerging sports. It seemed like we were kind of meh on pickleball and things like that. But we ignored half the population, women's sports. Why don't you make the case for investing in women's sports?
Yes, obviously this is my stump speech, so bear with me. But we are raising an at-scale fund to invest across the full women's sports ecosystem, and in large part because we don't believe this is just a moment catalyzed by Caitlin Clark domestically. There have been great female athletes in the past. In fact, many of our sports heroes over the last 3 decades have been women, but it hasn't seen this commercial jump and this leap forward in both investment and the profitability of those franchises. And I think there are 2 reasons for that. One, over the last 30 years, men's sports have started to go through the transition of rinky-dink mom-and-pop shops. And I understand when inheriting and running a business and turning around a business that was antiquated in its business model. That was endemic across sports. And over the last 30 years, they have increasingly professionalized. And there's a ton of support services that are going to ensure it stays that way, from data analytics firms to professional services firms, et cetera, that have professionalized men's sports. And so women's sports does not and should not have to go through that same 30-year doldrums that wander through the wilderness to have the infrastructure to run them like proper businesses. And this new ownership wave that's coming into women's sports is immediately professionalizing them. So that's one. But the bigger one is the demographic shift. 41% of all high school athletes today are girls. That's the closest it's been to parity. It's the net result of 20 years of you and I paying a ton of money, driving a bunch of miles, and spending a bunch of hours during the weeks and weekends on girls' sports. And because of that, there is now a built-in set of families that is not a big logical leap to suddenly pay for and watch professional women's sports. And so that's why we believe this isn't it'll be a 10-year run, no matter if I'm wrong, it's going to be a 10-year run in the growth of women's valuations and the broader ecosystem around it as it is today, just because of the trend and the fad. But we believe it's a 30-year run because the demographic shift that supports it is only accelerating. So that's my pitch on women's sports. And maybe one anecdote that I just discovered in the last couple weeks. One of our first warehouse investments is the Denver NWSL franchise that will start play next year. And we've had really incredible success applying the principles that we'd use at one of the major sports teams to drive this. We sold 12,500 season tickets for a 10,000 person temporary stadium, so we're already building a wait list. It's a really good spot. But as we looked at who those fans were, we were like, who are we cannibalizing? Is this the broader NBA, NFL ecosystem around Denver that's now just saying, okay, we'll give another additional share of wallet to women's sports? And that's what I expected. When we looked at the overlap, we only had 11% of overlap in our season ticket member base with the broader Denver sports population, the people that are spending money on tickets. I thought we did the math wrong. And so I went to a WNBA team confidentially that is owned by their NBA team, shares an arena with them, and I asked about their season ticket member base. They only had 8% overlap with their NBA team in that same stadium. So what that said to me is that we were onto something even bigger, that the growth engine for new paying fans into the sports ecosystem is women's sports. And so this is the growth engine currently, and that's why we're even more excited about it than when we launched.
So we started the day actually today with Scripps, who's talked about the success that they've had with women's soccer and women's basketball in particular. Others have talked about that as well. They've also talked about stepping in the shoes of RSNs, as a number of other broadcasters are. So we talked a little bit earlier before you came, Jason, about media rights not necessarily being a driver or impediment to rising sports teams' values. I do want to revisit just where do we end up, you think, in the kind of medium term in terms of sports rights? Is the NFL going to, is the Super Bowl going to be on Netflix one day, or is it always going to be on broadcast?
It could be. It could be on Netflix one day. I do think the mature sports, though, still have a locked-in allegiance to the fan base that likes linear and they like appointment viewing. You know, our fans are really upset when they can't find their game at 1 p.m. on Fox like it's supposed to be. Mm-hmm. They were upset. And we get complaints about it as though we had anything to do with it, which is part of being an NFL president, is navigating those. What women's sports is different in the demographics. It's younger millennials into Gen Z, young millennial families. They're fine navigating wherever because they're digital native. They're not a curmudgeon like me who can't find something and gets mad. They can find it anywhere they are. And I think as the major leagues make that transition, and they've struggled to do it, to make that transition to the next set of core fan base, I think these become opportunities. I don't think it's out of the question. But I do think the broadcast folks continue to step up. They continue to evolve. They continue to put money on the table. So I don't think it's any time in the near future. But I do think the emerging sports, the women's sports, you will see major at-scale events and the appointment viewing start to come around these other platforms. I don't know how everybody else thinks, but you probably already said. I'll look at the recording and find out.
Anybody want to add anything to those? No. All right. So why don't we go back to the audience for a couple of questions? Oh, you've got a mic. Sorry.
Hello. So my question is, how much power is there in owning the league or a whole system versus owning a team like Formula One or UFC through TKO, for example, versus MSGS or Atlanta Braves or Manchester United, and how does that impact their pricing power, and what does that opportunity set look like?
I'd be curious Jason's answer on this because I think it plays a big role in the women's sports ecosystem. But I'd say, in some cases you can't invest in the league level, right? You cannot invest in the NFL as a league. Our involvement there, we do think a lot about, buying an individual team is 1/32 of the league. It's basically 3%. And so you are getting the same look through. Now, I think that how you approach team versus league will depend on where in its evolution it is as well. And I think that comes with trade-offs and in certain cases, limitations on what the league will let you do. But Jason, curious what you're seeing in the women's sports landscape, because it feels like there could be a lot of opportunity there.
I think there's a ton of opportunity on both. The way that we look at it, and it has more to do with the risk profile of our fund. Like we are early PE to pre-IPO, pre-exit. We're not as much venture. And so I think that informs how we think about it. So for emerging sports, like our investment in League One volleyball, which we do think will get to the level of the NWSL and WNBA over the next 10 years. It's one where we wanted to invest in the holdco level because that's where most of the growth is going to come. Expansion fees, you get all of that coming into the holdco in that model. Team sales come into that model, so it really gets us to the kind of returns that we want for our LPs. but also because the holdco in emerging leagues tends to have a little more diversified portfolio. So League One volleyball would have been a little early for us just on the league. It's going to be successful, but it would have been a little early for the way that RIC evaluates things. But they have a 20,000 girl, $100 million youth volleyball business underneath it. That makes it a stronger balance sheet. There's a great exit on that from multiple different people who are in the market within the time frame of our fund. And so no matter what, we felt good about it. And so where that exists, we go holdco. I think in the more mature leagues, we like the team model, because it's sort of the same thing you said about the NFL. You're getting a chunk of the media rights. It's hard to get direct access to media rights, even if you're investing in ancillaries. And so in the NWSL, as those media rights grow, we get a chunk of those. As they expand, we'll get our as they further expand, we'll get more of those expansion fees to us. We paid a big expansion fee to others. We will get them in the future. And so I think it depends on your risk model, and that's where we land.
Outlook for expansion of the current leagues. Baseball's been talking about it. Hockey's been talking about it. Any updates on kind of where we stand with those? Sal?
Well, I mean, I think most people think it's a foregone conclusion that the NBA is going to expand to Seattle and Las Vegas. There's been a lot of talk about MLB expanding, but I don't think that's going to happen until after the CBA is settled. The most likely candidates there, I think, are Salt Lake City and Nashville. NHL talks about expansion. There aren't a lot of markets where I could see a successful NHL team. Houston is a pretty big demographic, doesn't have an NHL team. There aren't very many Canadian cities that... Southern Ontario is the largest and wealthiest hockey market in the world and has one team. That doesn't make any sense to me, but that hasn't made any sense to anybody for the last 50 years and still only has one team. And the fact that Rogers Communications writes a big check to the NHL every year and they happen to own the Maple Leafs, I'm sure has no influence on that one bit. So, I mean, leagues are always looking to expand, but they don't want to dilute the per-team share of the national media contract either. So you're going to have to get a pretty charming expansion fee to make it worth your while.
Anybody else on that? No? So we've got a few minutes left. I think we've answered the question as to whether we're in a bubble for sports rights or not. But what do you think could go wrong? Trees don't grow to the sky. What are the kind of impediments to seeing higher both dollar values and multiples in each of the leagues? Who wants to start?
Sal, you want to start?
Yeah, I'm happy to start. I mean, look, I don't see any drag right now. I don't. I have never been busier. Every time there's a control transaction, every time there's a limited partnership stake, prices go up and up and up. I'll tell you a story. We sold the Ottawa Senators, okay? The Ottawa Senators. Ottawa is the 44th largest market in North America. You cannot get on an airplane in New York City and fly to Ottawa nonstop. You have to go to Toronto and get on a propeller plane. It is nowhere, okay? We had 14 bidders. Forbes valued the thing at, I think, $600 million. So when we started the bidding started at about 600 to 625. And we wound up selling the thing for this is US dollars, by the way, not snow pesos. And we sold it for $950 million real dollars in the 44th largest market in North America, with a building that is not well located. It's way out in the suburbs, and the building's almost older than me. So you know when you buy that team, you're going to have to put $1.2 billion to $1.5 billion into a new building. And we had 14 bidders. So give me a break. I don't see things. Look, trees don't grow to the sky, and at some point the asset values will be so high that people will start investing in alternative sports. Look, I can't afford to get into the NFL because I can't write a $12 billion check. But I can afford to buy something else, and I will. And other leagues will benefit from that. But I don't think values are coming down. I just don't.
Yeah.
Last down round was George Steinbrenner's purchase of the Yankees. Is that true? in the Big Four sports?
Down round. Well, he paid $8.8 million for the team. He put in $1 million himself. His partners from Cleveland put in $1 million. And CBS, those geniuses at one of the biggest media companies in the world, did not understand the media content value of the freaking New York Yankees, gave him a $6.8 million note. Now, if you invested in the Yankees at $8.8 million, what do you think the Yankees are worth today? Anybody? Give me a bid.
10.
8? Good luck. See ya. I don't know. You know what I do know is that someone, and I won't name who it is, who's worth over $80 billion, said to me that whatever the high bid for the Yankees is, if it ever comes on the market, he will pay $150 million more. Doesn't matter what that bid is. So I know it's $150 million more than what anybody else will bid.
This is literally how the Broncos got sold.
Yeah,
This is literally what happened with the Broncos.
Exactly.
Hey, you guys can bid, but I'm just going to let you know we are going to pay more than the highest bidder. That's what happened with the Broncos. I would say to where I'm at, because I'm already in that next phase of the growth area for sports, and I think it seems like you guys talked about it earlier. My concern is there are too many things emerging. I don't think all of them have legs.
Too much competition for attention.
That's right. That's right. And there's only so much attention, and already in an attention-challenged generation that applies to these. And you need sticky fandom. You need people to engage on a regular basis, even if it's in bite-sized chunks catered to them. So I do worry about saturation, and especially because there are so many great leaders who are giving compelling pitches on these. These pitches sound great, and then when you get underneath that, our way of separating the wheat from the chaff is to look at actual youth participation, because again, that's our theory. Where are people and families spending money already? That will lead to spending money later. But where it's just recreational and low cost to start and low cost to finish and just leave it behind, I'm not as bullish. And so I think there's a challenge that too many things emerge and cloud the space and temporarily drive down the value of things that should accelerate. Hopefully I can get in at a discount now, and then as those spaces clear and the others accelerate, we'll do well. But that's one concern I have.
Yeah, we've seen no shortage of new sports businesses, IP owners start, and you're right. I think it's a very crowded space. I think it's sometimes hard to sift through everything. And ultimately, I think it comes back to, IP owners at scale, they're media businesses. That is ultimately what underpins these business models at the end of the day. And, there isn't unlimited media dollars to go around. And so I think, you have to be really careful and selective as to how you think about putting dollars to work in that ecosystem when there is so much supply of new IP owners that is starting as well.
That's great. I think that's a really great place to end it. Jason, I'm glad you made it. Arun, welcome to the panel. Thank you for joining us. And Sal, always colorful. So please stay tuned. We're going to talk about sports. We're going to talk about media. We're going to talk about sports gambling. Of course, we have the Atlanta Braves a little bit later. But right now, we're going to bring up Tegna. So thank you to all our panelists on behalf of everyone at Gabelli.